Hello, my name is Anish Lekapragada. I'm currently an 8th grader at Joaquin Miller Middle School in San Jose, California. I created Investing for Kids by a Kid so that pretty much anyone can invest regardless of their age, or at least that they'll know how to do it when the time comes. This course is designed for anyone, regardless of their age, to learn how to invest their money and grow it to achieve their financial goals, like buying a car, buying a home, taking out loans, saving up for college, and whatnot. It's such a shame that financial literacy is such an important skill to one's life that can determine almost everything, yet it's not even taught in school. So I hope that this course can make up for that. Now, one thing I want to specify here is that in this course, after these 4 lessons, you'll be comfortable doing these kind of things. Doing using stock screeners, finding out whether an ETF, index fund, or individual stock is best for you, figuring out how to look at a stock and what criteria you need to do to assess it, and building successful portfolios over the long term. Those are the main highlights that I will teach in this course, along with so many more. So please make a good decision and start the new decade by watching this lesson and staying tuned. Thank you so much.
Okay, well, I just want to say thank you for being here and just watching this video. It means a lot to me. But here, this is the slides I'll be going over, and I'd just like to clarify this right off the bat that it'll not just be these Google slides. There'll definitely be me showing you how to actually go into the website, how to buy the stock, how to use the website, how to kind of use the interface, how to interact with it, find what you need to use using stock screeners. So do not think that it's just going to be Google Slides. Although Google Slides is a great resource for like putting my material and whatnot, I do want to show you how to do it like in action and in practice. Okay, so I've already gone over main reasons why anyone should invest, regardless of whether they work on Wall Street. And the first three, buying a home, saving for retirement, college for your kids, that's kind of self-explanatory and the main reasons why people start investing. But enjoying just a little more money and having it as a side hustle has also started to grow as another reason why people may invest. They can do it as a side thing to make some money on the side on top of their regular job, and they can use it just to have a cash flow, for example. So I'm just trying to say here that investing has become so mainstream and so widespread that right now in 2020, there's really nothing stopping anyone from investing, regardless of what their age is. You don't need a degree to do it. You definitely don't need to go to any school, no college. You just need to just have a little patience and read some books about it, or just watch to my videos, for example. Thank you. So you don't really need a degree, and anyone can do it. There's nothing really stopping 10-year-olds or 12-year-olds or 11-year-olds from investing in 2020. So before I go over what I promised to teach you, I'd just like to show something with this graph. Now this is the Dow Jones Industrial Average. If you have no clue what these two words mean, that's totally okay. That's what this class is for. I promise you that by the end of this video, you'll have a clearer picture on what the Dow Jones really is, along with the S&P 500. And let me just show you two key things about this graph here. So first thing I want you guys to take away is that if someone invests here in 2006, they invested $1, they would get $1.36 roughly. But someone who invested here would get way more. They would get around $21.23, something like that. So that's why I'm saying that the earlier you invest, the more money you're gonna have. And it's not necessarily how much money you invest. It doesn't matter if you put your $10 to $20. The earlier you invest, the more money you're gonna have. Also, another thing about this is that it's definitely not a straight line. It has its booms here, and then it also has its dips, which is like the recessions here, where the economy goes down. But over the long term, it goes up significantly. So I'm just trying to say here that stocks go up and down every single day, but if you invest over the long term, it's going to be much easier for you to have a significantly positive gain than just trying to buy and sell on the daily. When you invest over the long term, it's not as hard to make easy returns. You let investing make your money work harder for you, and you can just sit back and relax more than if you're just trying to buy and sell, buy and sell. I'm not the only one to say this. Warren Buffett says the same thing, that long-term investing is the best way to invest, and plenty of other people agree with that too. So I'm just trying to say that if you invest over the long term, it's going to be much easier for you to get your money. To get your money to work harder for you and to make more money than just investing over the short term throughout the day like that. And this is Apple Stocks, which is a great platform to check for stock prices and whatnot on the daily. Now, what I promised to teach you is what stocks and bonds and many other asset classes are, how to evaluate stocks on criteria like risk, dividends, potential growth, etc., value, that kind of thing. Using stock screeners to find the hidden gems of the market, pretty much to find the stocks that match your interest, or match your interest meaning that they match what you're looking for. When a mutual fund, individual, or ETF, individual stock or ETF is best for you. How to actually build a successful portfolio over the long term is something I want to focus on. And buying the stock index fund ETF on the website, the mechanics of that, I really want to show that. And there's going to be so much more that will be packed in these 4 lessons. Now, the reason I decided to start this course is because it's really a shame that financial literacy is it's such a crucial skill. It determines whether people will be able to go to college, buy a home, so many other things. It's so crucial to so many people. It makes a difference in people's lives. Yet why is it not being taught in school? Investing is, it's not talked about that much, but its value is nevertheless paramount when it comes to sending your kids to college, as I just stated. So why isn't it taught in school? So I hope that this course can make up for that, and I really hope that it does. Okay. And so, if it does make up for that, or if you have any feedback, please let me know in the comment section. Thank you about that. Now, investing, yes, it's a big word, like it's showing here on the slide, and I just want to define what it is before there's any more confusion about it. Investing, in the most simple terms, when it's broken down, is putting money into commodities with the hope that the value of that commodity appreciates over time, resulting in more money than you started out with. So let's just define this. Putting money means you're buying something like a stock, but stocks and bonds are not the only commodities. This eraser, for example, is a commodity. This pen is a commodity too, because it's bought, sold, and traded. So you're putting money into a commodity, or you're buying it, and then you're hoping that the value of that commodity, of that stock, of that bond, of that eraser, of that pen or pencil will appreciate or go up over time, resulting in you having more money than you started out with, or more money than you put in the first place. Now, I'd like to dive into asset classes first, so there's no confusion as to what a stock or bond is, or what a mutual fund or ETF is. Uh, and just to define what an asset class is, an asset is anything that has value, like a stock or bond, particularly in finance. And a class is just the type. So we're just going to look at the types of stocks, bonds in the stock market, and etc. You'll see. So first, we're going to go to stocks, which are shares of a company. So best way I can describe to this, as cliched as this kind of expression is, it's still extremely realistic in getting the point. If we have this cake, slices of that cake are the stocks. Now, are the slices, right? So yeah, so if there's a company, then the slices are the shares or the stocks, interchangeable terms. So what I'm saying is that stocks are essentially pieces of company that are given out to people like you and me to buy. Now, I'd like to show a stock to you just as an example. Dow Jones here. This is Apple, famous stock. AAPL is the ticker. The ticker is pretty much used to resemble the stock. And here, this is Apple. It has its market capitalization, which is the total value. It has its price over here and whatnot. You have to pay that amount of price to buy one share of Apple. So the number of shares outstanding times the price of the shares is the market cap. So pretty much what that means is number of shares outstanding are the total shares that shareholders own are in the system of the stock market, pretty much. That they're being owned, they're being bought, they're being sold, they're being traded, whatnot. So that's around 4.4 billion for Apple. And if you multiply that, or you times it by 291.52, or the price of the share, you'll get the market cap over here, this number, 1.295 trillion, around 1.3 trillion. And yeah, that's pretty much what I'm saying, is that the market capitalization equals the number of shares times the price of the shares. Market cap, or market capitalization as its full name, is used to identify sizes of companies. For example, we say Apple is a greater company, or is a bigger company per se, than Google, or Alphabet here, because Its market cap is bigger. 1.3 trillion is greater than 923 billion dollars. So market caps are used to represent the size. Now, one thing I want to debunk right off the bat is that just because one stock's price is higher than the other does not necessarily mean that we can say that one stock, the higher price stock, is better than the lower price stock. That's not the case. Amazon has a greater stock than Apple, but we cannot say that Amazon is a bigger company than Apple because here the market cap is actually less than $1 trillion or $1.3 trillion. So I'm just saying here that A, the price has no correlation to the value of the stock or how good the stock is, and B, the price has no valuation, has no correlation per se, or yeah, for both, no correlation to the market cap or to how good the stock is. So there's no correlation there. There's no bond between the two. So never connect those things together. Now, stocks can also be used as a performance metric, which pretty much means people will say stuff like, oh, Facebook or FB went up so much today, the company's doing good, and vice versa. Stock went down so much today, the company's doing bad. But this is not necessarily to say that when companies are doing good, when they're being profitable, when they show that they're necessarily going to be going up. There's plenty of days, and there's definitely some times when companies are actually beating the reports of analysts and what they think, but the stock is going down. Companies hand out shares for the main reason that whenever you buy a share, you're helping fund their business and helping them expand their business. And the stocks increase in price over time as more and more people buy it. So in 2002, not many people bought the share of Amazon, therefore meaning the market cap was here. But the price increased over time as more and more people started investing into Amazon and buying shares. Now, sorry about that. Now, another thing about stocks that's very crucial when comparing it to bonds is that there's no fixed rate. We cannot say that a company is going to grow this much in 5 years or a company is going to go this much. There's no defined slope, like I said about the Dow Jones. So, so you cannot say that it's going to go that much. But a general rule of thumb is that the usual market goes up 7 to 8% annually. Now, bonds, you may have already seen that slide. Sorry about that. They're extremely similar to an IOU, which is an I owe you this amount of money. So, like the name implies, the interest is a profit on principal, which is a main difference. IOUs, I don't know whether or not they have interest, but bonds for sure do have interest. That's where the profit comes in. So bonds work in a way that you pay someone this amount of money, they give you that money along with interest, which is usually 2 to 3%, and they give you that money by a maturity date, which is specified, which both the person who lends the bond, like the company, government, or bank, and you would sign to or agree to. So this is example of a bond here. This is Microsoft corporate bond. It was issued out in 2017, and you're gonna get your money back. Expiration date of 57. I'm assuming that's 2057, 40 years later. Principal you put in is 05.35, and you get 1.12 or 1.08%. So I think it's clear here that stocks yield way more than bonds do in terms of return. That's also because stocks have a higher amount of risk when you compare them to bonds because bonds are fixed, like it's fixed yield and everything. Stocks are not fixed. It's like it's not called a security for that reason. Companies, governments, and banks give out bonds for the same reason as stocks, trying to accumulate money to grow their business. Corporate bonds given out by companies, municipal bonds by banks, and treasury bonds by the government. Government would give treasury bonds to fund projects like infrastructure, social security, that healthcare, maybe just paying off the big debt that U.S. has would be one reason U.S. would give treasury bonds. Now, treasury bonds are considered extremely safe because the U.S. government cannot default on it, saying that the U.S. government cannot say, I cannot pay this back by the time it's due, by the maturity date. That's what defaulting is. And the U.S. cannot do that because the U.S. has the right to print paper of their own currency. It's in their own currency. So the U.S. cannot say that they can default on it. And that's why treasury bonds are ridiculously safe. But they also provide low returns. So risk versus reward here is truly something. Now, bonds plus stocks, they converge into something called mutual funds. It's a combination of stocks and bonds together. Although there may be like 70% stocks and 30% bonds, the main gist is that they're combined together. It's a pooled investment, meaning people will give all sorts of money that they can, Person A may give $1 billion. Person B will give $5. Another person may give $20 million. It all varies. And then the people who run that mutual fund would pool all of that money together, and then they would invest it. And they're the pros. They know what they're doing on Wall Street. It's professionally made by brokerages and corporations. And actively managed fund and index funds are the two types of main mutual funds. I won't go over into index funds just yet. One second about that. But actively managed funds are pretty much where you pay someone, and then you pay a hefty management fee, and then they'll just trade for you. So you can sit back and relax while someone's earning your money for them. Now, mutual funds, they make their money mostly with the management fee, pretty much saying that aside from the money you pay them, you have to also sign to a management fee, meaning that however much is in your account, they take like a percent of that. And it's usually very small, like 1 to 2% is considered hefty or extremely large. Average returns in the sector of mutual funds are 7 to 8%, same here. And mutual funds tend to be safer because if one stock goes the other direction than expected and another stock goes the other direction than expected, they cancel them. The imbalances kind of cancel each other out. And also, when one stock goes up and another stock goes down, they neutralize each other. But usually it turns to appreciate. You buy mutual funds, you can sit back and relax. That's one of the advantages. You also don't need to work as much when buying a mutual fund because if you buy a stock, then you have to do your research. Advantage, you just sit back and relax. And another advantage is it's really hard to make that same mutual fund portfolio. Those are the pros who are making it. It's hard to buy those exact same stocks at the same order. Disadvantages is you don't have control of your money. Now, an example of a mutual fund, we'll go into Apple stocks here. Another great platform. DodgeX, Dodging Cox Stock Fund. This was actually created back in San Francisco. Here it is. Oh, and this is a watch list where pretty much you can watch whatever you want. And then here, yeah. So this is the Dodging Cox Fund. It's a mutual fund where they pooled assets. This is the market capitalization, 73.05 billion. Oh, and I may have gone over this, but this is what the watch list is pretty much. If I haven't stated it, I just clicked the green button, and then these are all the stocks that are on my watch list for me to watch out for. Okay. So yeah, that's what mutual funds are. Mutual funds are a huge concept when it comes to pooled investments in aspect to stocks and bonds. ETFs are virtually the same thing as a mutual fund, same pooled investment. Only difference is that they're updated every single second of every single day, so that Wall Street day traders can trade them. Because you see, this was the problem. Mutual funds, you have to wait until the end of the day. Excuse me about that. You have to wait until the end of the day to see the price of the mutual fund. The stocks do not work like that. Similarly, someone thought, why not make ETFs, exchange traded funds? They'll be traded like a stock at every single day. They'll be same pool of investment, but they'll be traded every single day. So Wall Street traders can use it and they can go in and out of the market quicker. Because mutual funds, you cannot go as in and out. There's not as much liquidity because there's some rules and there's a bunch of caveats about that. So the benefits of using an ETF on why someone would buy it is it's easier to use, much easier to use. You have better liquidity. You can get an instant settlement whenever you want. You can day trade with it, and yeah, that's why really ETFs have become so attractive. They're close to becoming a $20 trillion market. And an example of ETFs before I go into index funds is here. This is VXUS. This is the Vanguard Total International Stock Index Fund ETF shares. Now, ETF and index fund are usually interchangeable because they're both in aspect to a mutual fund. They both have pooled capital. Capital is a fancy word for money, and they both sometimes may track an industry. Something is called an index whenever it tracks an industry, and so VXUS is tracking the international stock market here. And this is what the ETF looks like, traded every single day. Now that just kind of leads me into index funds. Like I already said, it's tracking a certain industry, and believe me, there are so many industries you can track. There's biotech, there's pharma, technology is a huge sector in the U.S. Then there's also healthcare, as I already stated. There's steel, there's natural metals, there's natural gas, there's solar, there's electricity. There's all sorts of sectors that you could think about. They're either an ETF or a mutual fund. You just say index whenever it's tracking an industry. And the SP 500 and the Dow Jones, one of which you've already seen, are index funds because they track in the industry of the top companies. For example, SP 500 Here's SPY, which is a symbol of SP 500 ETF, also an index fund here. Tracking the top 500 companies. That's where the 500 comes in. So yeah, that's the SP 500, and Dow Jones tracks the top 30 U.S. companies. And so Dow Jones and SPY or S&P 500 are the most commonly used when it comes to doing stuff like saying how the market is doing. For example, news will say Dow dropped 30 points or Dow dropped 100 points. Points is the amount of dollars here. And then they would also say S&P 500 went up so much today to say the market is doing good or it's booming or something like that. So Dow Jones and S&P 500 are one of the most frequent terms when it comes to finances on CNBC and your other news outlets and whatnot. Now, this is a bonus. Hedge funds, not exactly an asset class, but very similar to mutual funds, indices, and ETFs, as I stated. It's the same pooled capital, except it's extremely risky because you see, when you run a mutual fund, there's an obligation that you have to announce to the SEC or the United States Securities and Exchange Commission about your data, about how much you're doing, how much money you're making, what are you doing. There's caveats and rules there about what you can do and what you can't do. Hedge funds do not have that much regulation as mutual funds, so they pretty much can do whatever they want. They can add loans, they can short, which I'll talk about what shorting is. They can do whatever they want. That's truly the essence of a hedge fund. And so, because they can do whatever they want, they're extremely risky. And because they're risky, you have to be extremely rich, wealthy, and knowledgeable to invest in them. So the SEC has decided that because they're so risky, we're not going to mess with them, but we're definitely going to put a rule saying that you have to be an accredited investor. Accredited investor means that you have a net worth of $1 million, or you make an annual salary of $200,000 or $300,000 when combined with your spouse. And if those two things are met, or if at least one of them is met, then you're an accredited investor, meaning that you can invest in a hedge fund. Now, hedge funds, they are notorious for terrible liquidity. That's because hedge funds, they mostly have the right to when they can take you out of the out of their fund and whatnot. They can decide when they're going to give you your money back, and they can decide whether or not they're going to give your money back. So once you're in, it's very hard to get your money back at the exact time you want it. Now, hedge funds, I'm just going to add something here that's not on the slide. The general norm has been that they're not allowed to publish anything. And, like, for example, in the Wall Street Journal, you can see an ad for advertising to invest in a mutual fund. But in the Wall Street Journal, you wouldn't see an ad on a paper saying invest in a hedge fund. Hedge funds are more privately invested, and because they're so for the rich, right? And so even the top names like Bridgewater Associates, Citadel, Clarium Capital, those are all big hedge funds, and the people who run them, like Ray Dalio, Kenneth C. Griffin, Peter Thiel, those are all big names, yet their hedge funds are not as well known because they're not allowed to market it.
Hey guys, thank you. I seriously cannot thank you enough. Seriously, you now know what an index fund, what an ETF, what an individual stock is, and what a hedge fund is too, even a mutual fund. Seriously, you're on the right track to becoming the best investor you know of yourself. Now, I have to ask two things of you. If you have any feedback for this video, please do not be shy and put it in the comment section below. And if there's anyone you think who might want to learn how to invest, to grow their money, to save for their financial future and their financial goals, please do not be shy and send this video to them. Until then, thank you.